Hi, welcome to episode 7 of Make It Count, Legal Accounting Made Easy with Benji. My name is Benjamin Ofeado. On our previous episode, we were able to bring to you an understanding of the statement of financial position. By the end of that lesson, we were able to ascertain the structure of the statement of financial position. Also, we were able to tell the differences between non-current assets and current assets, as well as non-current liabilities and current liabilities. Finally, we were able to deal with the similarities or the relationship between the statement of financial position and the accounting equation. On this episode, we'll be looking at the types of expenditure and the types of receipts. At the end of today's lesson, we would have been able to ascertain why it is important to even know the types of expenditure and also the types of receipts. What is the importance of knowing the differences? Also, we would have been able to tell the differences between the various types of expenditure and also the different types of receipts. So if you're ready, let's get into it. So one may even ask, are not all expenditure? Why do we need to differentiate between the two? And again, are not all receipts? Do we need to have different types? And why do we even need to know this? This is why. Businesses or investors or people who set out to start businesses do it most of the time with a profit orientation. And for them to be able to ascertain profits, you would have known by now when we dealt with the various types of financial statements. We spoke about the statement of comprehensive income, which allows us to ascertain profits. And we learned that to ascertain profits, it is we matching revenues or incomes against expenses. But the thing is, it is not all receipts or expenditure which would go into the statement of comprehensive income for the ascertainment of profits. And so we need to properly identify what receipts or incomes that would go into the statement of comprehensive income, as well as what expenses will need to go into the statement of comprehensive income for us to be able to ascertain the profits of the business for the respective reporting periods. Additionally, we need to properly classify the various assets or liabilities into the statement of financial position. As you would know, it is the statement of financial position that captures assets and liabilities, as well as, of course, the equity elements. All right? And this is why it is important that we know the different types of expenditure as well as the different types of receipts. Now that takes me to differentiating between the types of expenditure. There are two main types of expenditure. There is the first we call the revenue or operating expenditure and the capital expenditure. That is the revenue or operating expenditure and capital expenditure. How do we differentiate these two? And we are going to be differentiating these two on 7 bases of differentiation. 7 bases of differentiation. The first being their definition, the second being their purpose, the third being the duration of benefit, the fourth being the nature, the fifth being their accounting treatment, the sixth being their impact on profit, and then the seventh being their materiality. So these 7 bases of differentiation are what we are going to be using to differentiate between revenue or operating expenditure and capital expenditure. So now let's start with the definition. Revenue or operating expenditure are the expenses incurred on the day-to-day business operations of an entity. They are the expenses incurred on the day-to-day business operations of an entity. Whereas, when it comes to capital expenditure, they are the investments made in respect of long-term assets. They are the investments made into long-term assets. So when it comes to the definition, whereas revenue or operating expenditure has got to do with expenses incurred on the day-to-day operations of the business, capital expenditure has got to do with investment into long-term assets of the company. So that's the definition or the differentiation on the basis of their definition. Now let's look at their purpose. When it comes to revenue or operating expenditure, the purpose is to be able to maintain the operations of the business on a day-to-day basis, or they are incurred in order to generate revenue. I'll take that again. So they are expenses incurred to maintain the operations of the business or to generate revenue for typically a single accounting cycle, which we have learned is a 12-month period. In contrast, capital expenditure, they are expenditure incurred to acquire, upgrade, improve, or to extend the life of long-term assets. I'll take that again. So, whereas revenue or operating expenditure are incurred to maintain the operations of the business or to generate revenue, capital expenditure are those expenditure incurred to acquire, upgrade, improve the performance, or extend the life of long-term assets. So primarily, they are intended to improve upon the earning capacity of assets that are in the business's control. So that is the difference between revenue or operating expenditure and capital expenditure on the basis of their purpose. I hope that is clear. Now let's look at the third basis of differentiation, which is the duration of benefit. In a case of revenue or operating expenditure, these are expenditure that gets to be consumed or the benefits thereof consumed within a single accounting cycle, which we have learned to be a 12-month period, which is a year. And so typically, these are expenses, the benefits of which get to be consumed within a single accounting period. For instance, maintenance expenses or wages and salaries. That is an expenditure, the benefits of which is expended within a single accounting period. On the flip side, when it comes to capital expenditure, typically the benefits are intended to span multiple accounting cycles, which is multiple accounting periods. And so definitely the benefits are going to be more than, or their benefits are going to be for more than 1 year. I hope that is clear. So when it comes to duration of benefits, whereas that of operating or revenue expenditure is limited to a single accounting period, when it comes to capital expenditure, the benefit spans multiple accounting periods. I hope that is clear. Now let's look at the fourth basis of differentiation, which is the nature of the expenditure. When it comes to revenue or operating expenditure, these are regular expenditure. And what I mean by regular is they are recurring and frequent. They are recurring and frequent. And so for something like wages and salaries, they will happen at least 12 times in a year. That is if the staff are paid on a monthly basis, right? And so there is a certain regularity to their incurring or they being incurred, and it happens frequently. In the case of capital expenditure, they are irregular. And what I mean by that is most of the time, they are one-off expenditure and they do not also happen frequently. They are infrequent. For something like purchase of a vehicle, a business will not typically be buying vehicles at a certain frequency. As and when there is the need to purchase a vehicle, then they would buy a vehicle. And that's why we would say it tends to be one-off, an expenditure, and also it is infrequent. So that is the differentiation on the basis of their nature. I hope that is clear. Now let's look at the accounting treatment. So when it comes to revenue or operating expenditure, they tend to have a certain reporting frequency that gets to be done within the statement of comprehensive income. The statement of comprehensive income. And so these are expenses that are incurred and reported immediately. Expenses incurred and reported immediately as an expense in the statement of comprehensive income. But then when it comes to capital expenditure, these are expenditure that get to be what? Capitalized in the statement of financial position as assets. So whereas revenue or operating expenditure get to be expensed immediately in the statement of comprehensive income for the ascertainment of profits, capital expenditure gets to be capitalized in the statement of financial position as an asset, and then subsequently they will be depreciated or amortized into the statement of comprehensive income. But that is a matter we'll deal with subsequently. That's the issues or the concept of depreciation and amortization. So know this. When it comes to the accounting treatment, the statement of comprehensive income is where revenue or operating expenditure are expensed immediately. Whereas when it comes to the capital expenditure, they get to be capitalized in the statement of financial position as an asset. I hope that is clear. Good. Now let's look at the impact on profit as the sixth basis of differentiation. Impact on profit. Whereas revenue or operating expenditure have a direct impact on profit, where it will go into the statement of comprehensive income to reduce net profits, capital expenditure does not have a direct impact on profits. It will only have a derived impact on profits when there is amortization or depreciation of those assets into the statement of comprehensive income. And so when it comes to the impact on profit, revenue or operating expenditure have direct impacts on profit, whereas capital expenditure do not have a direct impact on profit. So the final basis of differentiation is the materiality. The materiality. In the case of revenue or operating expenditure, they tend to be smaller immaterial amounts. Smaller immaterial amounts. For instance, it look like something like expenses on stationery, or office supplies. They tend to be small, immaterial amounts relative to the entire performance of the business. However, when it comes to the capital expenditure, these tend to be material amounts. For instance, expenditure incurred on the purchase of a vehicle, or construction of a building, or the setup of a plant. These tend to be material expenditure, right? And so, on the basis of materiality, revenue or operating expenditure tend to be smaller, immaterial amounts which are recurring, whereas that of capital expenditure are big material amounts which tend to be non-recurring. And so that is materiality. And so that is it for the 7 bases of differentiation of revenue or operating expenditure and capital expenditure. Now let's look at some of the typical example of revenue or operating expenditure that you would find. We have something like wages and salaries, something like office supplies, something like repairs and maintenance, something like cost of goods sold, right, which will come into the statement of comprehensive income. So all of these expenses will be reported in the statement of comprehensive income. Let's flip it to capital expenditure. Typically, you would find, for instance, the cost or the expenditure on the purchase of a vehicle, or the expenditure incurred on the construction of a building, or the expenditure incurred on the setup of a plant. These are typical examples of capital expenditure. So now we know the difference between revenue operating expenditure and capital expenditure. Good. Now we'll look at the final item for this episode, which is the differences between revenue or operating receipts and capital receipts. Revenue operating receipts and capital receipts. Just like expenditure, we'll be differentiating these two on 7 bases of differentiation. Again, those are their definition, their purpose, the duration of benefits, their nature, their accounting treatment, their impact on profit, and also their profitability, or their materiality, right? So these are the 7 bases upon which we'll be differentiating revenue or operating receipts and capital receipts. So let's start with differentiation based on their definition. So revenue or operating receipts are receipts that are from the regular operating activities of the business or the entity. So from the regular operating activities of the entity, the incomes that are made or the receipts received from those are considered as revenue or operating receipts. Whereas when it comes to capital receipts, these are receipts from non-core operating activities of the business. Non-core operating activities of the business. For instance, it could be receipts from shareholders, which will be capital in nature, which will be going into the capital account, or from even the disposal, all right, of a big asset item, all right. So those are not typical day-to-day operating receipts. So that is the difference when it comes to the definition. And in terms of purpose, revenue or operating receipts are for the day-to-day management of the business. So those receipts from trading or from the core activities of the business, They are intended for the day-to-day management of the business. Whereas when it comes to capital receipts, those are receipts that come into the business, for instance, for major capital activities. For instance, for the acquisition of vehicles or acquisition of a building or the acquisition of an asset. Most of the time, that is what their purpose tend to be, right? And then in terms of the duration of benefits, just like its expenditure leg, revenue or operating receipts, typically the benefits thereof are intended for a single accounting period, all right? They are typically intended for a single accounting period, for the ascertainment of profits for the single accounting period. Whereas when it comes to capital receipts, the benefits thereof are intended for things beyond a single accounting cycle. And so, for instance, if it is a loan that was taken and we've received the loan, typically it may be for the acquisition of an asset. The benefit thereof is intended to span beyond a single accounting period. So I hope that is clear when it comes to the duration of benefits. Then the fourth item, which is the nature. Again, here, when it comes to revenue or operating receipts, the nature of it is such that it is regular and recurrent. Regular and recurrent. So for instance, if you are into the sale of goods, in a month, you may sell multiple units of the goods to your various customers. And it's a thing that has a certain regularity to it throughout the accounting period. But when it comes to capital receipts, they don't have that regularity and they are not recurring. They are not frequent. They tend to be one-off. And so, for instance, shareholders' contributions, they tend to be one-off receipts that will be received by the business. Something like a loan, it tends to be a one-off receipt that comes to the business. And so that's the main distinguishing feature between the revenue or operating receipts and capital receipts when it comes to their nature. Now let's look at the fifth distinguishing element or the differentiating basis, which is the accounting treatment. So revenue or operating receipts are recognized in the statement of comprehensive income as revenue. They are recognized in the statement of comprehensive income as revenue, all right? And so they will typically come into the statement of comprehensive income immediately recognized as revenue. Meanwhile, when it comes to capital receipts, typically they will be going either into capital, which is owner's equity, or will be going into liabilities, as maybe a loan, a borrowing, or anything of the nature, a similar nature as liabilities. And so whereas when it comes to revenue or operating receipts, it goes into the statement of comprehensive income as revenue. When it comes to capital receipts, it goes into the statement of financial position as either capital or liabilities. So that is it when it comes to the accounting treatment. Now let's look at their impact on profit. Revenue or operating receipts have a direct impact on profit, as it will come in to increase net profits because it comes in as revenue, and revenue is a positive function of profit because it increases profit. Meanwhile, when it comes to capital receipts, it does not have a direct impact on profitability. It does not have a direct impact on profitability because it gets to be even recorded in the statement of financial position and not the statement of income. And then finally, when it comes to the materiality, revenue operating receipts tend to be immaterial or small amounts that flow into the business. So for instance, if you make a sale to a single customer, probably you may sell about for a value of, let's say, 2,000 Ghana cedis. Meanwhile, by the end of the year, Your total revenue that you would have made may be about in the millions. You realize that that single transaction of 2,000 is so immaterial relative to your total revenue that you would have made in the year. And so they tend to be small, immaterial amounts per transaction as they come in. Meanwhile, when you go to capital receipts, they tend to be large material amounts that flow into the business. For instance, the capital contribution which will come from shareholders or a loan that has to be taken by the business, right? So I hope this is clear for the various 7 bases of differentiation. Now let's give some typical examples of revenue or operating receipts and capital receipts. In the case of revenue or operating receipts, we do have revenue, which is the main source of income for the business. So in the case of those who are involved in the sale of goods, then of course they are going to have it as revenue from sale of goods. For those in industries like, let's say, advertising or media, they will have it as advertising revenue. For those in, let's say, banking, they may either have fees income or interest income, right? So these are direct incomes that you typically find in your statement of comprehensive income. Let's flip it to the capital receipt side. For the capital receipt side, typically you may find share capital or capital contribution from shareholders, right? You may also have borrowings or loans from financial institutions. And so these are some of the typical example of revenue or operating receipts and capital receipts. So this has been episode 7 of Make It Count, Legal Accounting Made Easy with Benji. We've been able to look at the need to differentiate between the various types of expenditure and also the various types of receipts. So have we differentiated between revenue or operating expenditure and capital expenditure? And finally, we looked at the differences between revenue or operating receipts and capital receipts. My name is Benjamin Ofeado. Let's meet on the next one.